one nation, indivisible, with liberty and justice for all. Thank you, Perry. We have a very special program planned for you this morning. 2018 Local Housing and Economic Forecast with Jordan Levine, C.A.R's senior economist. Jordan Levine is an economist at the California Association of Realtors. As an economist at C.A.R., Levine analyzes housing market conditions, macroeconomic trends, and public policy issues through the use of external data from the public and private sector and from survey research studies conducted by C.A.R. He contributes frequently to C.A.R's market analysis articles, Housing Matters blog, and Market Snapshot, and has written on topics like housing supply, distressed sales, housing tax policy, housing affordability, and many other subjects relevant to the real estate industry. He earned a bachelor's degree in economics from the University of California, Santa Barbara, and a master's degree with merit in international economics from the University of Sussex. Please help me welcome Jordan Levine.
Good morning, everyone. Ooh, that was awesome. I didn't even have to go for a second round on that. So I'm happy to be here talking about our 2018 forecast and what we think is going to happen over the course of the next couple of months as we close out the year and then into 2018. The way that I always start is by turning this guy on. Is to start with a post-election outlook. I think we'd be remiss if we didn't talk a little bit about what's going on in Washington, D.C., especially in light of both the fact that all of our leadership just got back from the NAR meetings in Chicago, and also probably the calls to action that you've seen come out over the course of the last week or so. And I think that we want to really get into some of that stuff. And hopefully I motivate you guys to pick up your phones and call for the call to action and respond to that. Very, very critical things happening that are not just going to affect California's economy in general, but also the housing market, and so therefore our business as realtors, right? After that, I'll get into the economic update, talking about what's happening in the rest of the U.S. from a 30,000-foot level. I always try and sneak this in before I do the housing market stuff, right? Because although it tends to be more of the dry, kind of nerdy economist stuff, it does help to set the stage for understanding what's happening in the housing market. And so I like to give you that kind of broad contextual view before we drill down, of course, to what we see happening in California, and more specifically here in the Sacramento market. So I've been at C.A.R. for about 2 years now, and one of my big pushes that I have in the research and economics department is to localize the data as much as humanly possible. So I brought some of that along when I first started doing speaking engagements like this for C.A.R. Very first thing you hear is, you go out to Contra Costa, where I just was yesterday, and you say, hey, here's what's happening in Contra Costa County. You go, that's great, but in Brentwood, where I live, it's completely different than in Berkeley, Oakland, et cetera. And so I've been trying to drill those down at least to the city and zip code level, and I've done that again today. And I'll show you some of that, and then I will wrap up with the outlook on where we see things going over the next 12 to 18 months. I hesitate to go any farther than that because, honestly, the changes that have happened just since the tax reform stuff came out a week ago, it's already made forecasting impossible. And so going out farther than that's very difficult, but I will give you a sense of where we see things, at least over the short run, right? So, yeah, let's talk tax reform. This is, again, the crux of the call to action. I sent these slides out last week before I left the office, and since then it's changed a tiny bit, but ultimately we're dropping from 7 tax brackets down to 4. That bottom one's actually going to be 12%, not 10%, as I'm showing you on this slide. Ultimately, this is going to be a reduction in tax rates for a lot of folks, and I think that's ultimately a good thing. You never want to root against putting money in more folks' pockets. We know that renters are struggling just like homeowners, and so giving folks more of their hard-earned payback is an admirable goal. I think the thing that we're worried about is what are the impacts on housing and on home ownership in particular, and that's due to the fact that they're doubling the standard deduction to $24,400. So right now you can deduct $12,700 as an individual or a married couple, regardless of whether you rent or own. And if you buy a house and then end up paying property taxes, you send some of your income tax up to Sacramento, that typically catapults the regular homeowner well above that $12,000 threshold. such that you get a tax savings by becoming a homeowner. So now we're going to both increase that standard deduction by doubling it to $24,000, and also remove the ability to deduct the amount that you send up to Sacramento. So right now you're not paying Uncle Sam on that $3,000, $4,000, $5,000, how much ever it is that you send to Sacramento. That won't be the case anymore. So you're going to get a tax hit on that piece. And the standard deduction is going to remove that incentive to become a homeowner. At $24,400, you really need a mortgage balance that's at least in the $600,000 to $700,000 range at today's interest rates for it to make sense for you to go to H&R Block and collect all this paperwork and do all this stuff that's involved with itemizing your taxes, when you can just simply take a $24,000 deduction, win, lose, or draw. So it's really it's not going to eliminate the mortgage interest deduction, but it's really going to neuter it, right, by rendering it pretty much useless except for at the very highest levels of income. And so again, that's great for the renters' pocketbooks who are going to take home more money. It's a bad thing for those existing homeowners who are going to lose some of that deductibility they currently have. And I think the more concerning piece is that it reduces that incentive for folks to make that jump from becoming a renter to becoming a homeowner, right? And we've decided as a country for 100 years that we wanted folks to own their own home. We've had federal tax policy aimed at making that happen. And so we're already a state where the home ownership rate is dangerously low, and very close to being a majority renter state. And you worry again about the impact of that, not just for us as realtors. Obviously, the less folks who can become homeowners, the less sides for us to work on, right? But there's a deeper consequence for our state economy, for business recruitment, right? How are you going to recruit workers to come and work at your company when you can pay them $60,000 a year and they're going to have to shack up with 4 of their college buddies to afford a 2-bedroom apartment because of the cost of housing? And so that's really the big concern from a federal tax policy standpoint, and I hope you guys will get on the horn and do that call to action, which I know they're going to give you more details on the back end, but absolutely critical. This is not a done deal, and we're a very powerful voice in politics and things like that. And so if we can make our voices heard, then we can potentially get in there and protect home ownership. Of course, it's not just the nuts and bolts of home ownership, right? So really what I've been talking about up until this point is what's going to happen to my own individual tax bill, right? There's also what's going to happen to the macro economy as a result of some of these things. And again, you don't want to root against growth. You don't, in the same way that you don't want to root against putting more money in people's pockets, right? But given where we are in the economy, which is very, very near full employment, it's harder and harder to stimulate the economy and have that translate into actually more economic growth when you're at something near quote-unquote normal employment, right? At the beginning of this cycle, we were near 10% unemployment. If we wanted to grow as a business and wanted to hire more workers, there was lots of skilled workers on the sidelines who could quickly be reabsorbed into the labor market. Now at 4% unemployment, a lot of those folks have been reabsorbed. We added back all the jobs lost by the downturn, and so now when we stimulate the economy and a business wants to grow, they're often finding that they have to go out and compete against other companies for an existing workforce, right? And so it's not clear that that results in more economic growth. What it could mean is higher wages as you fight for this limited supply of skilled workers, which could lead, obviously, to potential inflation. So again, you don't want to root against economic growth. That's great, but just being realistic about what going out and stimulating the economy with tax cuts or even infrastructure spending, which may or may not happen, might actually translate into some potentially unintended consequences that could get ugly for the housing market. Of course, the bond market also cares what's happening with fiscal policy. Ultimately, when someone goes out and buys a U.S. government bond, they're essentially agreeing to loan the U.S. government money, and they're doing that on the basis essentially of our ability to repay, right? And so to the extent that we do these tax cuts without also cutting spending, that's going to mean bigger deficits and debt going forward, which means that we've weakened our underlying balance sheet as a nation, and folks aren't going to continue to loan us money on the same exact terms. That's when you start to see longer term bond rates go up, and that's when you start to see 30-year mortgage rates go up. Right now, the Fed raises rates a little bit, and we don't really see much happen with 30-year mortgage rates, right? They really only affecting the overnight rate, the short-term rate that banks charge each other. Those longer-term rates are really set by the bond and world financial markets, right? And so they're betting on the U.S. being a good bet and being able to repay those bonds as we build up more deficits and debts. They're going to want more, interest rates for that additional inflation that we generate in our economy. And so inflation's already near the Fed target. We think the Fed's going to continue increasing rates. We had about a 1.9% CPI growth. Even if you strip out those very volatile pieces, you're still talking about 1.7% core inflation, which is one of those very nerdy-ish topics, but matter for interest rates, because when it gets close to 2%, that's where the Fed wants it to be, and they're going to have that kind of political cover to go ahead and continue to raise rates as we expect them to do both in December and on through next year. And so, again, I think the moral of the story is that, we could potentially see, as we stimulate the economy with tax cuts and other stimulus spending, that it creates more inflation, and you throw that together with the bond market worries about bigger deficits and debts, and it could mean higher rates for the U.S. economy going forward. And I think that, the days of 3.5% rates are sadly behind us, I think, and I can say that fairly confidently. So what is the punchline on all this stuff? Well, in California, we already have high prices, right? Affordability is already a problem here in California. You throw on top of that the higher expectation for interest rates to continue to go up, and that's really the kind of 1-2 punch, right, for housing affordability. The homes are going to cost more, and it's going to cost you more to finance the mortgage debt on those homes. Of course, on the individual tax bill side, you have those existing homeowners losing some of those critical deductions like your state income tax, your ability to deduct tax on your second home, the fact that they are requiring folks to live in the house for 5 years instead of 2 before you can get that capital gains exemption, right? And there's myriad other ones that I hope we'll discuss in more detail when we get to the call to action. But I think when you throw that on top of the fact that there's now no longer an incentive for folks to become a renter, I'm going to get that tax reduction, win, lose, or draw, no matter what choice I make on housing, it could be bad news for home ownership, and in a state like California where home ownership is at about 53%, down from 60%, we really can't afford, neither as realtors or as an economy, to kind of tolerate any threats to home ownership. We're already in pretty bad shape on that front. So I tell you all this not to depress you, but hopefully to get on the horn and make those calls to your Congress people, because again, this isn't a done deal, and we can make something happen on this that will benefit housing for the long term, but we can't rest on our laurels. So that's why I spent this first 10 or how many ever minutes that I've spent beating this to death, because it's very, very important for housing and for California as a state, just if we want to have an economy anymore. In terms of the economy, things are, going well. In fact, that's probably the best thing that we can say that's happening right now, right, is that the economy is actually doing pretty well. I didn't bring my global economy slides, but if anybody knows my boss, Leslie Appleton Young, she always jokes that right now America's the cleanest dirty shirt in the hamper, right? We're not a great economy when you go back and compare us to our, heyday and our historical norms, but when you compare us to what's going on in the rest of the world with the European Union still kind of slogging along, China's got its issues, even those really fast-growing South American countries have hit the wobbles a bit, and by those standards, we're in pretty good shape. We had a 3.1% growth in our economy. In the most recent data, that's about average growth, but for this cycle, that's actually a pretty solid number. In fact, on the radio when this number came out, they said, yeah, we got to 3.1% growth, and everybody was really celebrating that, and I think that given that that's our historical average growth rate, I think that tells you everything you need to know about where the economy is at right now, that we really celebrate an average number. That being said, consumers are still firing on all cylinders, right? We're still buying cars, although not the 17 million we were, but they're spending money at retail stores, on Amazon.com, and everywhere else. Unemployment is actually lower now. We just got the new number that came out since I sent these slides up on Thursday, down to 4.1%. Job growth still hovering in the low 1% range. I don't worry about that low job growth number. You expect to see job growth slow down as you get towards quote-unquote full employment. So we're starting from a pretty healthy point, right? And that's, I think, one of the best things that we can say. This dark blue horizontal line here, navy, is that's our historical average growth rate, right? So if I was in the 80s as an economist and you said, what's going to happen with the economy? I could just roll the dice and say 3%, and probably more often than not, I was just going to be right. That's just what happened with the economy. I'm showing you the last 5 or 6 years, though, and you can see that but for a handful of times, we've never even broached that 3.1% growth rate. We've been growing for about 7 years now, right? Almost 8 years continuously from late 2009, and yet we've never had that kind of bounce back recovery, right? In the 80s, we always had those, what they call them, V-shaped recoveries, right? Where you have this kind of bounce back recovery, a deep contraction followed by a period of accelerated growth that you really catch up to where you should have been. There was no bounce this time, right? It was more like a splat where we fell and just kind of hung out down there at the bottom and then started to grow again at like historical norms. So we never had that kind of catch up, get me back to where I should have been period. And I think that explains a lot of the, what I would call psychological scar tissue out there. When you go out there and ask folks, how's the economy doing, right? They don't feel like it's doing particularly well, and yet we've had upwards of 8 years of ongoing growth pretty much continuously except for 2 quarters there. And I think that really does explain the gap, right? We didn't have that. We had the splat recession, not the bounce recession. That being said, we continue to add jobs. Even in California, the pace of growth has slowed, but we're still adding jobs at about 280,000 job per year pace as of the most recent data through September. That's obviously lower than the 4.5 to 500,000 that we were at in 2015-16. Again, that was when we were still, quote unquote, catching up. So I'm not too concerned about the fact that we're slowing down in terms of overall job growth. The unemployment rate is down near 5%, which I think for California is about as close to air quote normal as we're going to get. And of course, 300,000 jobs on an annual basis, give or take, is nothing to sneeze at, right? That's still a pretty robust number. The one thing that does worry me is the fact that we're starting to slow down relative to the rest of the United States, right? So full employment can explain why we'd expect to see job growth slowing down. You don't grow as much when you're in full recovery as you were when you're kind of in recovery mode. But what it can explain is that for the last 67 months in a row, up until the last 5 months, so up until June, California had grown faster than the United States every single year for 66, 67 months in a row, right? 5.5, almost 6 years, doing better than the rest of the nation, despite all of our warts and other issues and things like that, our hostile business climate, all those typical criticisms that we hear about California. Despite all those things, on the left-hand side, you can see that going back to early 2012, we outpaced the United States every single solitary month, right? And so the fact that we're slowing down in terms of growth doesn't worry me. The fact that we're growing now slower than the rest of the United States and that we don't have that advantage and aren't outperforming the rest of the United States is worrisome, and it's also something that I lay squarely in the lap of our housing market, right? This is something that we've been able to grow despite our challenges with housing supply and housing affordability, our unfriendliness and things like that. And I think that those issues, which we've been able to kind of persist and grow despite those things, are becoming more and more insurmountable, right? That they're becoming too difficult. The inventory is becoming too tight, and affordability has deteriorated too much to where we can't kind of grow despite those issues anymore, and they're starting to become very, very strong headwinds that are actually not just holding back the market for us as realtors, right? We're feeling it first because we're out there on the front lines. We've been talking about this for multiple years, right? But it's also starting to eat into the overall business climate. In fact, if you look, USC just put out a new poll where they surveyed businesses, and businesses said, look, I can't recruit here anymore. I can't offer a wage that's high enough to make this job attractive enough to these folks who have other options. I don't know if you guys follow us on Facebook, but I did a very simple cartoon that just looked at wages for a computer programmer in different locations across the U.S. There's only about a $20,000 a year difference whether you're a computer programmer in San Francisco or you're a computer programmer in Austin, Texas. Guess what the big difference is? In Austin, Texas, you save about $900,000 on the cost of that medium-priced home. So guess what? You can cut my pay by 20 grand all day long if you're going to rebate me 900 grand on the cost that I have to spend to become a homeowner. And so you can see that that's a theoretical construct right now, but it's starting to turn into reality as we bleed more and more people to Arizona, Nevada, Texas, right? It's not that the Phoenix economy is on fire. It's that their median home price is $230,000, right? And you can go out there and take a 30% pay cut and have a house with 4 bedrooms and a pool and a games room. And so that's really the tail of the tape when we train these highly skilled people and got all these great universities up and down the state and spend all this money subsidizing this great education so that we can train Nevada's next 21st century workforce. It's going to be disappointing, right? And you see it in the jobs numbers in terms of where the economy is growing, right? I color-coded this, and in typical economist fashion, I didn't tell you what any of these colors mean, but The point I wanted you to take away here is that the purple is the Bay Area, and these tealish colored ones are Southern California. The red is the Central Valley, and what you can see is that it's not the Bay Area and the Southern California coastal economies leading the pack anymore. They were the first out of the gate. They have a lot of this kind of technology base that we were able to leverage to recover and weren't hit as hard by the housing downturn, but they're even worse in terms of undersupplying their economies with housing than we are, and their affordability and supply issues are even worse. And so right now, the Central Valley and places like the Inland Empire down south are laughing all the way to the bank as we pick up all those refugees who can no longer afford to live in these major employment centers, right? But that's only going to last so long because, as I'll show you in a minute, even here in Sacramento and throughout the Central Valley, we're actually even underbuilding. It's not just a coastal California thing. We don't build enough here relative to the amount of jobs that we're creating here, and guess what? Our inventory and our affordability is rapidly deteriorating, right? And so this is no longer going to be the San Joaquins, the Modestos aren't going to be bedroom communities for the Bay Area and Sacramento employment centers anymore. That's going to be commuting from Phoenix or wherever it is, or you're just going to move there eventually. And so I guess the good news is that over the short run, we're going to continue to benefit as we pick up all this spillover folks who want to own their own home but just have no option to do it. But over the long term, that's not sustainable, right? Those people also come with their higher incomes, and guess what happens to the cost of housing out here? It goes up and actually is deteriorating at a faster and faster clip as we pick up more and more of those $100,000 a year people. I mean, my brother-in-law lives in Concord, where I was staying last night, and that used to be the affordable area for folks who worked in San Francisco, and you could go out to Concord and buy a relatively, now it's out here, and pretty soon that line is going to continue to go further and further, and it's a function of underbuilding. So down off my high horse, but I did want to point that out. The good news is that almost every single sector of our economy is growing, including construction, which is absolutely critical, right? But it's all the way across the board, from high to low wage jobs, tourism, wholesale trade, even the government, which is critical here for Sacramento, has started to grow at a 2.2% annualized clip. The one thing that I think, again, is a red flag is that you're starting to see some job losses, not just in manufacturing and mining, which have been kind of on a long-term downtrend, and I don't expect to see manufacturing come back anytime soon. But the fact that we're seeing job losses suddenly in the professional services, right? That's our tech stronghold. That's our absolute bread and butter that's carried us through this downturn. And I think the fact that we're seeing some chinks in the armor there, again, is a function of the inability of us to offer a decent quality of life in these major tech and coastal employment centers. And, I don't think that you're going to see the Facebooks and Twitters of the world kind of pick up and close down shop in the Bay Area and leave California completely. But I think when it's time to grow and expand, right, they're going to look at offices in some of these other areas, right? And you're going to be seeing all these little mini Amazon type HQ2 battle for my business. And so they're not going to leave here, right? But they're not going to grow here, and their growth's going to happen somewhere else. And that's bad news for our economy, obviously. In terms of how that's all playing out in terms of the housing market, it's, for all intents and purposes, fairly flat, right? If you squint at this, you can see there's been some modicum of growth this year. In fact, we're up about 2.6% in terms of closed sales from where we were through the first 9 months of last year, right? But if you go back to the expiration of that first-time homebuyer tax credit, right, 2009-10, we had a big pop in response to that first-time homebuyer tax credit, but since then we've been essentially flat. We've bounced around at about plus or minus 420,000 or so sales per year. And I didn't bring it with me today, but if I zoomed that chart out and showed you back to the 1990s, that's about the same level of transactions that we had in the mid-1990s, when there was about 30 million people instead of 40 million people in California, and we had, about 150 or so thousand realtors, not 200,000 realtors, right? And so shows you not only how tight the market is, but how difficult the business of being realtors is when there's more and more people fighting over fewer and fewer home sales. We started the year with a real big bang, right? Everybody was pretty optimistic after the election. I think everybody thought the Fed was going to come out of the gate firing this year and raise rates a lot more than what they actually ended up doing. But as a result, we pulled forward, I think, a lot of the sales that were going to happen this year into the first quarter of this year. By March, we were about 5.5% ahead of where we were through 2016 at the same point. Since then, the pace of growth, and that's this kind of reddish line here, has decelerated every single month since March, right? April was lower, May was lower than that, June, July, and so on. And so, again, I think that it isn't a sign that we're, I don't want you to read too much, I guess, into this 2.6% growth rate. We're growing, but I think it's because a lot of the sales that were going to happen throughout the year happened earlier. We're actually projecting that we're going to underperform, and pending sales seems to suggest that the next couple of months are going to be fairly flat going forward as well. Of course, here in the local market, I brought condos, I just wanted to, for my own due diligence, look at the condo numbers, but we're still an existing single-family market for all intents and purposes, but almost the same exact story of what I showed you statewide, right? If you squint at that, you can see we started off this first quarter with a decent surge in home sales, right? But since then, it's cooled down pretty consistently, and actually, we're doing a little bit worse than what you see in the rest of the state. We're pretty much flat, down 0.7% through the first 9 months of the year here in the Sacramento board, right? I like to break this stuff out by city to see what's going on. I was surprised to see that, the top 5 basically represent almost 80% of all the transactions, right? So if you're thinking about where to target your marketing or where to concentrate your efforts and things like that, I would say that most sales happen in what I would call the quote-unquote core of this market. The right-hand side shows you what's happening in growth in each one of those top 10 markets, and you can see that the growth is pretty lumpy, right? Sacramento is up about 1.6%, but we've had some pretty steep reductions in transactions. Elk Grove, Folsom, some growth in some of the what I would call smaller but bigger core markets, Orangevale, North Highlands. But again, it isn't a one-size-fits-all across the board. And I think this, if I had to put my finger on this, I'm guessing that this has a lot to do with price points, I'm guessing. Yeah. So this is another way to look at that same chart, basically. It's kind of a canary in the coal mine, right? I like to look at not just what the overall growth rate is, but to see how broad-based that growth is. So I just simply ask the question of those 22 or 23 markets that I'm showing you here that members of this board work in, how many of them had more transactions this year than they did last year, right? And what you can see is that almost 60% had more transactions. Unfortunately, you've had some reductions in some of the bigger ones that have actually held back the overall growth number. But still, a lot of growth, and I would suspect that some of this stuff is happening where there's less of an inventory constraint, maybe in the higher price points, that can continue to see increases in sales growth, right? Prices tell us what's going on. When you look at prices, they've been growing for about 8 years straight. After that, again, that lull in after the first-time homebuyer tax credit expired. Since then, prices have been going up unabated. They're at $553,000 in September when we, I guess I'll spoil my own forecast here and say that, by this time next year, we'll have bashed through those original peaks that we set back in 2005-06 timeframe. We're forecasting that the median will eventually exceed that $594,000 peak price and get into the 600,000s, although it's taken us about 10 years or so to get back there. Oops. And the same thing is happening here in Sacramento. We're a more quote-unquote affordable market, but everything is relative. In fact, I'm kicking myself now for not stocking up on 1 million properties back there in 2009. I wish I would have had boatloads of cash because I wouldn't have to be here doing this speech right now. The median price of the home has more than doubled, right? And so if you bought in 2009, God bless, you're doing great. But, for the folks who haven't gotten into the market yet, the price has doubled, right? And you're up against it pretty hard, especially as rates start to rise. And in fact, not only are prices going up, they're starting to accelerate, right? So we started to see prices go up at about a 4.5-5% clip during the first part of this year. There was a surge in home sales. Some folks put their homes up to list, but since then, I think everybody's kind of come to grips with the fact that the economy isn't going to come flying out of the market, that there's not going to be this huge wave of new inventory, and maybe it isn't a great time to, even if it's a great time to sell my house, who wants to turn around and be a buyer in this market? Holding back on those listings, and what you see is that the pace of price growth now is appreciating as nobody's putting their houses online, still creating all these jobs, incomes are starting to grow, and lo and behold, you see home prices here in Sacramento starting to get up towards the double-digit growth territory. So not only have they doubled, and not only are they still going up, they're going up faster than they were even last year, right? And so again, not to be the wet blanket at the party, but just these affordability issues aren't going away, and I think you got to be aware of that, and you got to be the educators out there on low down payment options and all kinds of creative ways that we can get folks into home ownership, and even just having these conversations about where interest rates are going and what it's going to do to how much house you can afford, things like that, because think of that. If we could have got more people into home ownership in 2009, 10, 11, we'd have a lot more wealth and we'd be a lot more stable of a state right now. A lot of folks miss that kind of once in a lifetime opportunity, and it's really, really sad. Lot less ambiguous when you look at the canary in the coal mine on home prices, right? If you ask which of those 23 or how many ever cities I showed you are growing, it's 9 out of 10 are seeing price growth, right? And we got a fairly diverse set of markets where prices range from the kind of mid 200s all the way up into the high 500 range, but the bad news is that they're going up all the way across the border. I guess the good news or the bad news, depending on whether you're trying to get folks into home ownership or accumulate wealth yourself. But it's all because of a lack of supply, right? And we can talk about this pretty much for an hour in and of itself. I could have done a whole session on supply, but it's even worse here in Sacramento than it is in the rest of the state. The most recent data, we had 2.6 months of supply or unsold inventory index. That means that if no new listings came on the market, then at the current pace of sales, there would be nothing left to sell in 2.6 months. That's about, actually it's less than half of what would be considered quote unquote normal, right? Normal market is 6 months of supply, maybe even 7 months of supply. We're operating at less than half, and that's why you see prices going through the roof, right? Folks are getting jobs, they're earning more income, and there's nothing out there to buy, and so it's like, moths to a flame, and whatever inventory's out there, everybody flocks to it, and you got to fight over it, and it's just a very, very difficult situation, which is obviously a huge obstacle to folks getting into home ownership and boosting our home ownership rate, et cetera, and also growing just the overall business for realtors. And unfortunately, Grumpy Cat reports that it's not getting better anytime soon, right? Not only do we have low levels of inventory, but the number of active listings have been declining for over 22 months in a row. In fact, every single month this year, they've declined by at least 10% or more, right? So not only, 2016 was no picnic. I think there was only 3 months of supply last year. Now we're at 2.6 months of supply with active listings dropping by double digits, right? So you can't buy what's not for sale, and I think that's the tail of the tape. It's almost remarkable to think that we are up 2.6% in an environment where there's been 10% or fewer active listings every single month for the last year. It's pretty incredible, and I think by that standard, the market's actually doing better than we could even expect. But when I talk about tight inventory, it's really a tale of two markets, right? If you're talking about the high end of the market, the luxury market, $1 million, $2 million, $3 million plus, there's no inventory constraint, right? You're talking about 7, 8, 9, even 10 months of supply at the very top end. It's the starter homes, it's the entry level, it's the fact that we've now got all these folks back into employment and getting wages where there's no starter homes available for sale. I'm actually surprised that there's even a category for under 200 anymore. It's such a rare thing, right? If you find a starter family home of 3 beds or more for under 200,000, I want you to bag it and bring it back to the lab for me so we can study it because they're just so rare. And you see on the active listing side, again, that double-digit reduction in active listings is purely at the bottom end of the market, right? Down by almost 30% for under 200,000. There's just no under $200,000 homes in California anymore for all intents and purposes. At the top end, $3 million and up, we're putting our homes up. We're going to sell a $3 million home all day long. The price is great. I've got boatloads of equity and all that good stuff. And you can see that lack of listings is really what's eating into home sales, right? So where listings are down the most and where inventory is tightest, there's no growth in home sales. We do a monthly webinar where I just kind of run down, here's what happened with prices and sales last month. We started doing this chart. The first month I did it, the only red bar on this one on the right-hand side was the under 300,000, right? And then when I did, that was in August. And when I did the September numbers, now it's starting to infect the upper price categories. Now 3 to 500 is also down, right? As supply and affordability deteriorate as more of the housing stock slides into those upper price categories, you just end up not having a bottom end of the market anymore. And so viewed through the lens of home ownership, it's going to be really, really difficult to turn that home ownership decline around in an environment like this. Again, not to depress you, but to motivate you to not just respond to the hopefully NAR call for actions at that federal level, but also to get involved in advocating for supply here at the state and local level too. And we have some initiatives underway to make that happen in California as well. Again, in terms of active listings, it's actually worse here in Sacramento, right? So they've been down even more, and Grumpy Cat's even grumpier. It's been 33 months of consecutive declines. Again, more than double digits every single month this year. So this isn't just a Bay Area or an LA type phenomenon, right? This is right here in our own local board. Of course, we've got a lot of our stock in the sweet spot, what I would call the sweet spot, right? I think almost 80% of our housing stock is under 750,000. I think when I went to San Francisco, it was the exact same chart, but just flipped around, right? Where 80% was over 750,000. So, we still have a lot of our stock in what I would call the quote unquote sweet spot to attract those first time home buyers and people who can't afford to own in Contra Costa or something like that. Folks who are working for the state government here in Sacramento. That's, perfect. Unfortunately, we're hemorrhaging those affordable listings, right? So down, again, that tale of two markets. When I talked about 33 months in a row of a decline in active listings here, it's all, basically under $400,000 homes, what we're talking about. At the top end of the market, $1 million homes, people are feeling like selling. That might even be a red flag to watch out for as folks at the top cash in, right? The kind of everyday Joe is usually the one holding the bag at the end of the day. And so, to the extent that we see an ongoing trend, this just started in the most recent month or two, so I don't think it's an alarm bell or anything like that. But if that continues for, 6 or 8 months, then I'll be concerned about the sustainability of the rest of the market. And of course here, again, same exact thing you saw statewide, under 200,000, down by almost 50% here in Sacramento. So even in the local market, there's just no, you don't get $180,000 homes anymore. Not so at the top end, still going along. But that really brings us to competitiveness, and it's just absolutely fiercely competitive out there. And I think a big piece of that is what I mentioned on the return of the retail buyers. So I commend you guys on filling in the field about financing description. I don't know, is that a required field for this board? Some boards, they don't fill it in, and so I can't do this chart everywhere I go. But this one, you can see that the number of all cash has been continuously declining since 2013, and the number of financed, what I would call the quote-unquote retail owner-occupant coming back for about 3 years. That makes it extremely tight at the bottom end in addition to all those investors. They might not be all cash, but it's still a great time to be in the rental business, and it's still a great time to borrow somebody else's money to do it. And so, I think that's put a lot of pressure on the bottom end of the market in particular here. And what you see is that the bottom end, so instead of breaking it up by price point, this is statewide data that I broke up every market into its top, 20% and next 20% in terms of price and so on, so that we could look at top and bottom end, and I could combine San Francisco and Sacramento and things like that. But what you can see is that there's almost twice as much price growth at the bottom end of the market, those 20% most affordable homes growing by double digits at the top end, except for that very top end of this 96 to 100. I don't know, that again might be something to look at as the top end cashes in for a sustainability leading indicator. But outside of that, you can see much faster price growth at the bottom. Those $200,000 homes are quickly being priced up into $300,000 homes, whereas the top end are growing much more slowly, about a little bit more than half. Time on market's down pretty much across the board, less than 30 days, but it's a little bit lower again at the bottom end of the market, so you can expect to sell very quick if you're in those most affordable price categories. In general, you can expect to sell quickly anyway, unless, like me in my most recent transaction where you overpriced the property, then that's a seller issue, not a market issue. But outside of those, you can expect to sell pretty quick. So And you see the same thing here in Sacramento. Actually, it's even a little bit lower at the very bottom end of the market, 12 days, right? You put that thing on, you barely go out for coffee, and it's come back down off the market. And again, it's all at the bottom end, right? At the top end of the market, you might have to sit around for 30 days or a month, which is, still very fast by historical standards. But compared to that person who puts up their $300,000 home, you better, if you got buyers in those categories, you better get there quick and have your offers ready to go, because they're going quick and it's trending down, right? It's been going that way for a long time, and so it just keeps getting tighter and tighter and tighter as listings continue to dwindle. And it's very competitive, right? When I break it up into those same 20 percentiles, sellers are getting exactly what they want, right? You're getting 100% of list price on median. That means that 50% of folks are getting more than 100% of their list price. In fact, I further subdivided the top 20% of homes in terms of price. And you can see even in the 85th, 90th, 95th, it's only till you get to the very top 5% most expensive homes where you're seeing any discounting at all. And even there, we're talking about 98.2% of list price, so you're cutting about a 1.8% deal off a list price. If you're a seller, you don't feel a lot of pressure to cut any quote-unquote deals. If you got a buyer who's waiting, I'm going to wait till we can get a really great deal. I don't know how much effort you want to invest into that, or how many, because there's just not a lot of deals out there to be had. Or you might just want to have do some managing of expectations there, maybe bring some of these charts and say, let's be real. And you see the same thing here. Oh, my title got all messed up. But you see the same thing here in Sacramento across the board, right? It's not till you get to $1 million plus, even $750,000 to $1 million, right? You're talking about discounting of less than 1%. It's really just only at the top end of the market. Anybody who's below $750,000, again, you don't feel any pressure to do any kind of concessions. And of course, it's probably going to remain tight. Interest rates are still very low. I actually brought the long-term chart. Yeah, my dad would kill for today's rates. This was my dad, right? When he used to drag me around to parties in the 80s and there was a 15.6% mortgage rate. My dad's out there, I got my 12%, guys. And it puts in perspective this 3.9, right? We had the quote-unquote taper tantrum when the Fed said they were thinking about raising rates, and the markets freaked out, and we went from 3.8 to 3.9% mortgage rates, and everybody had a panic attack. Well, it's still very affordable to buy a house with somebody else's money, and I think that's going to keep demand for housing pretty strong, all things considered. When they do hit, it will have a pretty big impact, right? Even just jumping from 3.5% where we were before the downturn up to 5.5%. A lot of people think we're going to go even higher than 5% over the next 5 years. But just even going to 5.5%, at the state's median home price of $553,000, you're talking about going from about $1,990 a month upwards of about $2,400 a month or $2,500 a month. That's about $600 a month more, and we know the typical homeowner or just the typical household in California who makes about $65,000 a year, they don't have $6,000, $7,000 a year left over to pump towards the exact same home that they could have bought last year in November at 3.5% rates. Same way to look at this is to look at it in terms of how much income you need to qualify for that median-priced home. At 3.5%, you needed, we think, about $105,000 to get into that median-priced $553,000 home. At 5.5%, you need $125,000. I know realtors don't typically work for wage and salary type of compensation, but I can tell you as a salaried worker, when you go into your boss's office and say, hey, I need a $20,000 raise because the cost of housing went up, the conversations don't tend to last that long. And so, I think the interest rates have been our one saving grace up until this point, but once they start to go up, whether it's to 5 or 6 or God forbid 7, it's going to have huge impacts here in California, where affordability is already abysmal. We actually just did the third quarter number, went down to 28%, right? And that means that 28% of folks can afford the median priced home. I'm actually actively lobbying at C.A.R. for us to turn this equation around on its head and start talking about it in terms of the percentage of folks who can't afford, right? Because at 28%, that means 72% of households cannot afford the median priced home in California, right? And so it's really hard to envision a scenario where home ownership goes up when 3 out of 4 folks can't afford to buy a home. It's just It's bad news for California, and it's true here in Sacramento. Again, it's not just a Bay Area thing, right? We've got about a 14 percentage point gap with the rest of the nation. So even in Sacramento, which is one of our quote-unquote affordable markets here in California, we've got way less affordability and way less of a shot of owning a home than you do in most any other part of the nation, right? And that's a problem. Time to worry? I don't think so. We're seeing really high price to income ratios. I'm getting asked a lot about bubbles, so I wanted to bring this to talk about, where prices are relative to the sustainability factors. We're at 8. That's not the double-digit territory that we were when home prices fell apart, but there's no doubt that home prices are growing faster than incomes. Again, I mentioned that our one saving grace was interest rates. So once you adjust that home price for how much it costs you to carry that mortgage at current rates, and then compare that to incomes, it's kind of back to what I would call our historic levels of unaffordability, right? It's not affordable if you drew that for any other state in the nation, but it's not high by historical standards necessarily. That's purely due to low interest rates, right? If interest rates start to rise, I showed you what that does to the payments in this chart on the right-hand side would start to look a lot different, but we're not in critical territory yet. This is just a thought experiment where I asked, what should home prices be, right? If you had people spending the quote-unquote right amount of money, and we know how much people make and what interest rates are, what would be that market clearing price where you just had the 50th percentile buying the median home and so on and so forth all the way on down? Perfectly clearing equilibrium market. The median home price should be somewhere between $365,000 and $425,000 here in California. So at $556,000, it suggests that we're about 24% overvalued. The prices are 24% higher than what they would be if the market cleared. Well, guess what? The market has never cleared. I don't say this to imply that the market's going to fall apart. We're not, twice as high as what we should have been like we were back in 2006 when the home price was 50% of what it actually was. But, it's something to keep an eye on. The good news is that it's not evenly distributed. Back in 2005, you could have put a blindfold on me and put up a map of California. I could have thrown a dart, and wherever it landed, that market probably would have been 30 or 40% overvalued, if not more. That's not the case this time. I did that same thought experiment county by county, and what you can see is that all of the ones that are overvalued are predominantly clustered in the San Francisco Bay Area, right? San Francisco, Santa Clara, Alameda, Oakland, those folks. In fact, at this point in time, there's a lot of markets where the price could even arguably be higher than what it is right now given low rates and incomes, and I think Sacramento is somewhere in the middle of the pack here, but Sacramento is not one of the ones that's overvalued. So even if a correction does happen, I don't expect it to be widespread. I expect the Bay Area to take a haircut, maybe Orange County to a lesser extent, but the rest of the state where we have this chronic undersupply and pretty good incomes and prices that aren't overblown, we should still be in good shape even in a worst case scenario. So how do we get here? Real quick soapbox thing. I talked about home ownership, taking it on the chin. We simply don't build enough, right? This is the state's numbers, not ours. You need to build 180,000 units just to keep affordability in check. That's not to start to improve affordability. That's to tread water on affordability. Never got there in the last 10 years, and we have a 30-year deficit on top of that, getting nowhere near chipping away at this. So if you think the supply issues are going to go away anytime soon, they probably won't. I'm showing you here the fundamental calculation. We don't need hindsight on this one, folks. You create, like Los Angeles did, 440,000 jobs over the last 6 years, and you only permit 100,000 new housing units. Guess what happens to affordability? It gets worse, right? You can't have only one new house for every 4 jobs you create and expect housing costs to stay the same. We're just as bad here in Sacramento, or just slightly better off. It's not just a coastal California thing. We've added 110,000 jobs through the end of last year and permitted less than 30,000 housing units, right? So you can't, again, have those kind of conditions and expect home prices and affordability to improve. This is such a nerdy and econ type nerd chart, but go with me here. What I'm showing you on the bottom is that gap between the number of jobs created and the amount of housing units that are permitted. So, in San Francisco at 8, that means they only created 1 new house for every 8 jobs they created. And lo and behold, it's no surprise that 88% of folks can't afford the median priced home there, right? They've got a housing index, affordability index of 12. But here's Sacramento, right? We're only building 1 house for every 4 new jobs that we create. And so, I just worry that our days as a quote-unquote affordable market are numbered if we don't start to get our act together even here, right? So we like to think that this is a a coastal elite issue. We need to build more in the Central Valley too, all the way up and down. I was in Tulare a month ago, and I was telling them we got to build here too. We're underbuilding in Tulare and Kings County even. It's not, it's across the board. We seem to have this very big stigma about wanting to build. Of course, the second reason is that nobody wants to move, right? The housing that we do have, people aren't turning it over. 71% of baby boomers are people who are at least 55. They haven't even moved at all this century, right? They haven't moved since the 90s or before, right? They don't want to move. You have a lot of folks who are locked in by, I said low rates, right? Why am I going to give up this sweetheart 3.5% mortgage deal? Hey, I bought this house in the 70s and my property tax base is like, $80,000 still. I'm not giving that up. Maybe I've got a boatload of equity. If I sell that, people laugh at about California complaining about the capital gains hit, right? But at $500,000, that's not infeasible that there's a sizable chunk of baby boomers out there who bought in the 70s and early 80s who have well more than 500,000, and the boomers are the ones who own all the housing in California. So when we did our survey and asked sellers, how many years do you live in this house before you sold this home? We've done this survey for 30 some odd years. Last year was the first year it got into the double digits at 10 years. This year was an all-time high at 11 years. The average person lived in their house 11 years before they sold it, right? And you see more and more folks just remodeling and staying. I didn't bring this chart for time's sake, which I know I'm already over time, but people are spending money to stay in their house. And of course, there's the rise of the single-family rental business, right? This used to be largely a mom-and-pop type game. We've seen anywhere from 400,000 to 1 million units change over from single-family owner. Right at the peak, we had almost 7 million single-family owner-occupied units. That dropped to about 6.5 million at the pit, right? And at the same time, we've seen the number of single-family rental units go from just shy of 1.9 million units to 2.7 million units and growing. That means there's anywhere between, 500,000 to 1 million units that are just no longer even out there to turn over. And guess what? It's still a great time to rent properties, and I don't see those coming back anytime soon either. In fact, there's now 3 publicly traded companies who do nothing but invest in single-family rentals, right? And that never used to be the case, where you could go on the stock market and buy real estate companies and things like that. They did a bit of multifamily, built some, and did some of this and that. There was never 3 that just did nothing but buy single-family housing and rent them out. So when you put it all together, I know I've beat you to death with many things, but if I had to sum it all up, I would say that the economy is still in decent shape, right? It's lumbering along. We don't want to go out and pop the champagne corks or anything like that, but it's moving forward at what I would call a decent clip. That's not our problem at this point in time. I mentioned the chinks in the armor on job growth, right? Which, again, I place that squarely on the shoulders of housing, which is just becoming increasingly unaffordable and unavailable, and therefore inhibiting businesses' ability to recruit and grow. But, despite all that stuff, the market just, I would say, continues to defy gravity, right? We're growing in terms of closed sales. Prices are continuing to go up. In fact, going up even faster than they were a few months ago. The lack of supply is really the name of the game there, and it's making the market very competitive. Things are selling very quickly, and rates are still really low. And I didn't mention this, but household formation is happening, right? Mom and dad have finally felt they've got the kind of social cover that after their kind of new grad has had that job for a couple of years. It's like, dude, you got to get out of the house. And so we're seeing that happen finally. And so the demand for housing is there both from a rate side and from a household formation side. And it means that the market's super, super competitive, right? So you can sell it quick. You can sell it for what you want. If you're buying, you're in trouble. Take this last chance to be the Debbie Downer and say that there's a lot of challenges out there, though, right? And so please respond to the call to action. They're going to give you the number later on, right? Of course, the lack of new listings isn't going to go away. All those things that are keeping my father-in-law from moving out of his 3,000 square foot house that all my, brother and sister-in-law and things grew up in. He's like, I like my neighbors. He's not going anywhere. And so those supply issues, I don't think from the boomers are going to go away anytime soon. The market's going to be tight. And then, of course, rates are going to start to go up eventually. And that's really going to be the 1-2 punch for affordability. And that's without even really getting into all this structural stuff on capital gains and Prop 60 and 90, Prop 13, and all that stuff, which we could, again, do all day long. But I would say that I'll end on a positive note because the demand is there. Despite all these challenges, we've continued to grow for 8.5 years in a row. The high end, especially where there is no supply constraint and where the high income earners are doing well, right? The stock market's at all-time highs. Those folks' incomes are rising. It's a great time to be in the rental business, and so I think that there's still a lot of room to run up at the top end. Of course, home prices, I would say in general, in California haven't gotten to an unsustainable level, and I think that's particularly true in this market. If we were in San Francisco, I'd be doing a lot more hedging right now, but the market is defying gravity. I think it's going to grow. We're forecasting that growth is going to average out at about 1.0% in terms of closed sales and about 5% in terms of prices. The U.S. economy is going to lumber along at about the same pace, but we do see interest rates rising to about 4.3% as an annual average next year. That's probably end up next December somewhere around 4.5%, so the average out the year at around 4.3. That's the biggest thing I would call out there. In terms of California, the housing market, again, growing by 1%, mid-double digits on prices. Unfortunately, it's going to mean that, and I vow that the next time I come back we'll get this changed, where 74% of folks will no longer be able to afford the median priced home, of course, and that's going to be a challenge. That being said, I think it's, I say this not to depress you, but to hopefully motivate you to both do those calls to actions and to step up your game, right? Because when you look at this, although we don't have a lot of growth in closed sales, we do have growth in prices, and when you put those two things together, the actual volume out there available for commission to be captured is going to be the highest it's been in 10 or 11 years, right? And so being aware of these challenges, you'll hopefully be able to navigate those and go out and have the absolute best year ever, and hopefully that's been helpful to help that happen. I would now shamelessly, before I get booted off with the Shepherd's Hook, promote my Housing Matters podcast. If you guys want to listen to that, we talk about all this kind of stuff and housing stuff. If you want to, nerd out with me on the job stuff. We have a lot of new interactive market data where you can go down and look at some of the stuff that I brought up today at the city level, even down to the zip code level, at the luxury market. There's stuff where you can, print out a city level market report and take it to a listing presentation or share it on social media or whatever. So with that amount of shameless self-promotion, I will say thank you so much for having me.